Welcome back to America's Commercial Real Estate Show. I'm Michael Bull. Thank you for being with us. Our show today is Hotels 2018. This segment is brought to you by ArborCrowd.com. If you want to invest a small amount of money in a large investment commercial real estate property, visit ArborCrowd.com. Well, please welcome my guest today. We have David Marvin. He's founder and president of Legacy Ventures in Studio One with us. David, thanks for being with us.
Pleasure to be here.
We also have Brian Waldman. He's Senior Vice President of Investments with Peachtree Hotel Group, and he's in Studio One. Brian, thanks for being with us.
Thank you for having me.
Well, gentlemen, you guys are on the firing line. You guys are developing these hotels. You're buying them. You're selling them. You're operating with them. You're operating them. And there seems to be a lot going on in the economy, in the world, and the hotel industry, with technology. How do you know what's coming ahead of you? What is your outlook? What do you think you're going to see in your industry coming up this year?
Sure. We look at the hotel industry. We are pretty bullish on where things are going. If you look at the economy today, we think the economy is on strong footing. Peachtree focuses more on investing in secondary and tertiary markets. We're more of a select service investor, so we're investing more in the Hampton Inns and Courtyards of the world, and predominantly invest with Marriott, Hilton, IHG, and Hyatt. We feel like that's been a good space for us, and we've gotten a healthy risk-adjusted return for that. I think when you look at the industry as a whole, the fundamentals continue to remain strong. If you look at the prognosticators, most of the data that we've seen has been pretty healthy going into 2018. But the one thing that we always say about the hotel space is it's still a street corner business, and it's really important to understand the markets and the submarkets that you're investing in.
David, what do you think?
I agree with everything Brian said. I think basically the hotel industry has enjoyed the ride with the economy coming back strong. Not in a unbridled way, but in a steady, improving way. And the hospitality industry, as other real estate segments, is guilty in times past of overbuilding, creating too much new supply. And for a variety of reasons, demand growth has not been met with an oversupply in this cycle. Supply is beginning to hit on a national basis. New supply is beginning to hit demand growth. But fundamentally, new supply has been constrained by capital being tight and by the cost of construction. New construction has absolutely spiraled since the recession. And for those two reasons, the hotel industry, despite our instincts as real estate developers, have been constrained from overdoing it. So the fundamentals are very healthy. Demand in terms of room nights occupied has never been stronger.
That's great. So what do you guys think about the tax cuts? I mean, if the hotel industry was looking good and now businesses may have more money to spend and invest and create jobs, and if individuals might have more money in their paycheck to spend for leisure, does that adjust your thinking for 2018?
For me, I'm extremely optimistic about it. I think that basically the benefits of encouraging business with tax cuts has been sort of underestimated by a lot of analysts. I think that the sense of optimism, I think that the benefit of job growth and investment will buoy the economy, and I think that the hotel industry inures to the same kind of dynamic. I think we're going to enjoy more travelers. I think we're going to enjoy people having more money in their pocket to do leisure travel. Commerce is going to be up, and that is going to generate more commercial travelers as well.
And did it adjust your employment thoughts in your own companies for next year? I mean, are you guys going to have more money to invest in your businesses? Do you feel like you will?
I think from our perspective, a couple things. First, I agree with everything David said. I think The other
You're supposed to argue with me.
I think the other interesting thing is when you look at the hotel industry today, this is going a little bit off topic, but hotels are operating pretty close to practical capacity, as David said. Occupancies are near historical peaks, which means that as we have more money and as those leisure travelers are spending more and as companies are spending more, that gives us the ability to drive rate. And I think that from an investment perspective is really appealing, just in the sense that for every dollar that comes in rate, you're going to have a lot more that flows down as opposed to occupancy. And by operating at near practical capacity, I think we're really at a point where our industry should hopefully be able to drive more cash flow as a result of it. To answer your second question, just in terms of our investment outlook, we continue to raise capital, and I wouldn't say that our investment thesis has changed significantly as a result of the new tax law, but I think it certainly doesn't hurt. And I think we're optimistic that there are good opportunities out there, and we'll continue to try to find those opportunities. I think from an investment perspective, when you look at the opportunities that are out there today, a lot of what we're seeing is very fully priced. There's a lot of capital chasing hotels today. So again, I think it's really important to pick your spots and pick your markets to find the best investments.
So is it time to sell then? Are we at that time of the market where maybe some owners should take some chips off the table?
For us, we're always looking to buy and sell. I think that we sort of look to create opportunities. I think in the hotel space, one of the things that differs as opposed to other classes of commercial real estate is in other classes of commercial real estate, I think a lot of investors are really focused on cap rates. I sort of look at cap rates as you're looking in the rearview mirror. When we're looking to buy, we're looking at how do you create that opportunity going forward, and we're looking for value add opportunities where we can create new cash flow. So if you have an asset that's stabilized and you've already sort of locked in that value add, I think it's a great time to be a seller.
Yeah.
I look at the trades in the market, and kudos to the broker community. I think you guys are doing a fantastic job. The assets that we've had out there, we've gotten really good pricing for. I think it's harder to be a buyer today, but you have to be selective and find those right opportunities where you can create that value.
Yeah. You agree, Dave? Time to buy, time to sell, time to build?
Yeah, our business thesis is different from Peachtree Hotels. We are a much more rifle shot shop. We don't do the volume of transactions that they do, and so it really is an asset by asset basis. But we've just sold a hotel that we developed and have owned for 10 years, and very glad to be in a position now to recycle that capital. And we have plans in 2018 to sell, and this relates more to sort of reaching that point that Brian just spoke to, which is the property will be stabilized at the end of 2018, and we think it's a good time to sell. So, I think that it's good to harvest. It's good to adjust your exposure. So we're buyers and sellers as well, but a very rifle shot approach.
Well, we brokers like the thoughts, and we agree with that. So you mentioned that you're seeing really good occupancy trends in the market around the country, but it seems like the room rates haven't gone up quite as much. Is that going to change in 2018? Is technology one of the things that are kind of keeping those caps on rates, or what is it?
Well, it's interesting. It's the old line hoteliers would say that this could never happen. It's sort of defying the laws of nature.
Yeah, if you're full.
If you're full, and understand that if you have 80% occupancy, that could well mean that you're 100% occupied Tuesday through Thursday night. You've got some availability, Friday, Saturday, Sunday, Monday. So I think there's a number of reasons why we've yet to hit that inflection point where there's been good growth in ADR. But invariably, my belief is that the laws of nature will kick in, and ADR will start to grow. And as Brian referenced before, growing revenue through ADR is a beautiful thing because much of that flows to the bottom line. There's not additional incremental expense that's immaterial anyway that encumbers that. So again, new supply is really on a national basis just meeting new demand. So we're bumping along at a historically high occupancy level, and I think that rate is the next thing to drive.
Yeah, I agree with all that. And the two things that I would add is when you look at new supply, and I think when you listen to the pundits and you look at what has historically, thrown the hotel industry off of a good trend, it's been supply. I think when you look at the data today, a lot of that is really specific to a handful of markets. You look at New York, for example, San Francisco, Nashville. Those markets have a lot of supply, and New York, I think, probably has too much supply coming. Some of that supply is warranted. But once you get out of those top 10 markets, supply really doesn't appear to be as much of an issue this cycle as it has been in the past. And I think the same thing on the rate side. As we reach that, what I call practical capacity, and David's point, you're 80%, but you're sold out 4 nights a week. That gives you the ability to drive rate. I think what we've seen in some of the bigger markets that we're not seeing in the smaller markets is the impact on compression nights. So you have a Super Bowl in town, or you have something like that, that really gives you the ability to drive rate. But with the Airbnb and other things like that that are out there now, that's taken some of that compression away that you've had historically. The markets are still doing really well. Sometimes it's harder to get that compression that you've historically gotten in past cycles.
Yeah, that's interesting because of technology, consumers really have a lot of opportunities out there, right? Is that one of the things that's kind of keeping the rate growth down a little bit?
I think it is. In certain markets, interestingly, I think the sharing economy is having an impact. So New York City, when the Pope comes to visit, right? That incremental bump that hoteliers hope to get, taking their rate from a hypothetical $500 a night to $1,000 a night for this very super special event with great compression, a little bit of the air has been let out of that balloon with the number of, say, Airbnb rooms that are put in service. So that's one of the drags in markets where Airbnb is a factor. It's not a factor in every market.
Yeah, that's great. All right, we're going to take a short break. When we get back, I want to ask you guys about some of the opportunities you see moving forward, and maybe also some of the challenges that you guys are looking out for. So stay with us. I'm Michael Bull. This is America's Commercial Real Estate Show.